Okay, sorry about the technical troubles, but we are back with Jeff Parent and we've got his top picks. First off, it's a regional banking ETF. We did touch on regional banks at the top of the show. KRE is the name of this ETF. You reckon that some of these regional banks are unfairly discounted, Jeff?
Well, not unfairly discounted. It's, the question of value is it always comes down to what is it trading at. And what I'm seeing here is a big sell-off in a sector that I think people are going to be reevaluating for value and possibly buying. A lot of consolidation right around where we are right now, about the $43, $44 level, and a really good solid base above $40. So I think this gap that formed between $60 and say $40 earlier this year in March, I think a good portion of that's going to be recovered, and we can see this particular unit trading upwards of $50. A lot of this is based on interest rates. And so this is another play on interest rates declining and this inflation fear declining. And that's my market outlook, and it's one of the past top picks, right? So it's a bit of a theme we have going on here. Not an uncommon theme, by the way.
Kimberly-Clark is your next idea, a classic defensive stock?
Yeah, it's exactly. And, if there is ever another COVID, I think it did very well, but I'm not going to jinx it. But the good long-term trading range over the past couple of years, almost 3 years now, and it's at the low end of the trading range. So as a short-term trader, you can see maybe $10, $15 on a stock like this, and it pays a little bit of a dividend to carry you through as well. I'm trying to find a good mix here. I don't want to have a bunch of stocks that are overly risky. I want to find some holdings that have a mix of, say, growth potential and also dividends. And this fits the bill.
What about these big branded consumer stocks in the States generally? Do you have a thesis on those, Jeff, or do you take it company by company?
Yeah, company by company, definitely. I do, my analysis is multifaceted. I look at top down, bottom up. I look at the fundamentals and the technicals as well. So I'm looking for different, in terms of diversification and risk reduction, you want to have a little bit, maybe 3 different types of stocks. So not necessarily growth and value, but from a chartist perspective, something that's beat up, something that's doing well, something that's about to break out type of thing.
And then your final name is involved in training, also, I think, helping help customers get used to procedures, to Chabo.
Yeah, it's an interesting, it's a Canadian company. The first 2 are U.S. And this is a stock that trains, has a lot of online training, good series of clients. And this is a stock that is starting to break out to the upside, and I do like it. It's been basing mostly for most of this year after a decline from I think almost $92 before bouncing down to 23, which is not unusual considering what it does and what we've been through. But the breakout now is encouraging, and it's being done on some volume. And so I'll be looking at this one. I don't own any of these stocks, I should state. But this is something that I probably will be buying in the next couple of weeks, so you can trade with me if you like.
So you don't own any of those stocks, but you're strongly inclined to buy all 3 of them?
Yeah, I'm going to probably buy 2 out of the 3 as a minimum, if not all 3, and add to my portfolio. I've got about 22 stocks right now, so this will bring it up to my complement of about 25 stocks in what my main portfolio is, which is called the North American Diversified.
Right, so pretty narrow portfolio. Is it painful sometimes? You have to sell to make room for new shares?
Well, I've been holding on to cash for a long time. It's been painful to hold on to cash. It's been more of the problem. But I've got some good growing stocks in there. Like in a year-to-date basis, it's kind of weird because you look at 2 years, it's a very different picture than a year-to-date. And so I mentioned Shopify. That's done phenomenally well and added a lot to this year. So holding on to stocks like Shopify through the downturn. And, I can have a debate about why I've held on to it, but I'm glad I did. And so that's sort of what the portfolio is. I think too many more stocks in 25 and it becomes unmanageable.
Right. Oh, so you've hung on to Shopify through all the ups and downs?
Yeah, I wish you could see me hanging my head low right now.
Okay.
But my original purchases are around the equivalent of $20.
Oh.
In the low $20 range. So it's just breaking above $100 again finally. And it's like Amazon and some of these other stocks in the same business. They're starting to do really well here, and hopefully we'll see it get back up to maybe not $200 anytime soon, but definitely in the right direction.
Okay, well, listen, thank you very much indeed for joining us. It's always great talking to you, Jeff. First idea, CVS Health frequently comes up on Market Call, and the stock has lagged a bit.
It has. So has a lot of the healthcare sector in general. We think that CVS is a very interesting play. So you've got the CVS brand of pharmacies in the U.S. They also own a company called Aetna, which is one of the large HMOs. Healthcare insurance. They have a pharmacy management company that they own, that they do institutional business with. And then finally, they bought recently a company called Oak Health, I believe, which does medical care with doctors. And so you sort of have the quadfecta, if you will, of integration from top to bottom. Ms. Lynch, Karen Lynch, I believe, is the CEO. I think she's doing a phenomenal job. The stock is not expensive. On their last call, they reiterated that they should be having earnings of $8.50 to $8.70 per share. I think the stock is around $70, so I think you're looking at 8.5 times earnings right now. They did take on some debt to make some of these acquisitions in the last couple of years. So that has been a knock on the company. But I think that when you look out over the next 1 to 3 years, you're getting a very nice dividend, a not expensive multiple. And we think that once they get the integration behind them, they're going to be able to ramp up the free cash flow. I might also add that most recently, Rite Aid went bankrupt. And Rite Aid was the sort of third wheel competitor between CVS and Walgreens. So I believe what's going to happen is a lot of Rite Aid stores may close down. And at the margin, CVS is going to be able to pick up some of that business, which is going to flow to, CVS or Walgreens.
Is there a worry that there are just in too many different aspects of the healthcare system and people can't fully decide, well, what kind of a play I'm getting here?
That is always a concern. It's the old holding company argument. Oh, you don't want to own a holding company because they've got too many irons in the fire, and we want more streamlined. But I think what CVS has done is they have many complementary businesses. So you come into the front of the store to buy some snacks while you're getting your prescription drugs. Maybe you're going to get some kind of medical advice from a doctor, perform some kind of a test. And then the pharmacy benefit management and the HMO is on such a big scale that I don't think it really matters.
Onex Corporation's your next idea, and this stock trading at its highest in at least a year.
Yeah, so let's look at this chart. This is very interesting. So when you look at the past peak here in 2022, when most markets peaked, I think it peaked at around $100. And then it had a very precipitous fall here, all throughout 2022 and into 2023. What's interesting to us, and if you look at this chart, it's a very similar kind of formation, so almost a cup. Maybe I didn't draw it as well as I could have. Cup and handle type of formation. So leaving aside the chart for 1 second, wonderful business. Jerry Schwartz is no longer at the top of the helm. Mr. LeBlanc is the new CEO. He has been at the company, I believe, since '99, so almost a quarter of a century. Viewers may know one of their top holdings, which is WestJet, which they bought quite a while back, but they have so many different businesses that they've bought and sold. And what caught our attention is that if you look at the last report, the company's intrinsic value, in our view, is somewhere in the $130, $140 range. And the stock is, what, $90 today? So there's potentially a very big disconnect that the market either isn't appreciating or doesn't believe. In the meantime, management has done what it's done very well for the last 20 years, and it's been acquiring its own shares at what we think are very good prices. And to our knowledge, in the last couple of quarters, they've become more aggressive on their acquisitions. So hopefully that's going to just accrete even more so on a per share basis for us remaining shareholders.
Okay, Bobby LeBlanc, the boss of the company. And then finally, Manulife Financial.
Yeah. We think Manulife is a juggernaut, and we come back to how do you play in the financial services industry. We think that right now, the life cos are in a great position. Why? Because interest rates are higher than they've ever been, which means that perhaps when they underwrote their policies, they were expecting to have much lower returns than what they can have today. Today, you've got a company that is buying back stock, has an ROE of 17%, pays a 5.5% dividend yield, and has a LICAT ratio, which is the regulator's number that they need to hold in capital, of 137%. So in our view, not much to not like, and a juggernaut to participate in.
Right. I notice it's been outperformed lately by Great-West Life, investors moving in there. Is that a name you've spent much time on, Great-West Life?
No, we haven't. We've preferred Manulife specifically because of the geographic footprint that they have.
Mike, that was great. A great debut. Thank you very much indeed.
Thank you for having me. Appreciate it.
First idea, as previewed, Alteryx, AYX in New York. So part of its shtick here is any data worker can work with the streams of data organizations take in.
Absolutely, and you don't have to be a coder.
Okay.
Right? And so not only that, but the whole data analytics side is only as good as the data that you own. And so the benefit of Alteryx is that you can have data in different locations. It can gather it, assimilate it into one package, and then do the data science and analytics behind that. And so the software is designed to make advanced analytics accessible to any data worker out there. But it's a young company. It's only a $2.7 billion company. And it was very, very leveraged, and when interest rates started to go up, they just got clobbered. But you can see it on the charts that it's actually sort of found good grounding down here, and it has a great long runway. So certainly right now sitting around $38, and we have a 12-month price target of $69. So it's a great, great runway.
Accenture is your next idea, the consulting company. A lot of its work IT these days.
Yeah. I forget who told me, but it's in one of the top 5 employers in the world. It has 732,000 employees under Accenture's. It's a behemoth when it comes to consulting and outsourcing. It has partnerships with all the big cloud guys of Microsoft and Oracle, Amazon, Google, and so on. It includes more than 75% of the Fortune Global 500, 97 of the top 100 clients in the S&P. And to boot, it's got a 1.5% dividend on top of that. And they're not letting down. Actually, this year, they've already done another 19 acquisitions. They just came out. I haven't been to it, but they do have one of these AI studios here in Toronto. So they have these Accenture Innovation Hubs in Chicago and Houston, New York, San Francisco, and Toronto, and also in Washington. They just got into a partnership with Salesforce. Salesforce, of course, bought Cerner, and so they're very much heavily into the life sciences side. And as I mentioned, they're into the whole generative AI collaboration with everyone under the sun. So current, and you can buy it here. I think I'd add down around 316 and also down around 300.
That's amazing, isn't it? Yeah, as of August, 733,000 employees.
Yeah. I actually was very, very fortunate, and I had a meeting with a few other analysts with Julie Sweet.
The CEO, yeah.
The CEO. So they have a leadership team of a few dozen, and they're spread all around the world, as you can imagine, with that many people. And so they don't have a head office, but their leadership team actually gets together on various Zooms and Zoom and Teams, and they all have avatars. So they actually, walk the talk and talk the walk.
Finally, Samsung Electronics. A Korean flagship company. What do you like about them?
Well, going into next year, who knows what the landscape is going to be like within the Western world. I think the hard times have already been felt within sort of China and Asia, so it's a bit of a bet on sort of the Asia-Pacific area. But Samsung, it's a mammoth company, and they're second to Taiwan Semiconductor as a foundry. Now, Taiwan Semiconductor has about 59% share. Samsung has 13% share, but their idea within the next 5 years is to actually double that.
You don't hear much about them as a chip maker, Samsung.
Yeah. Well, they're the world's largest DRAM chip maker, which is the memory side.
Okay.
And so even Apple jobs out a lot of their chips to both Taiwan Semiconductor and also to Samsung. So they have a great suite of products. They just reported, great report. They're also very much talking about, the cyclicality of the semiconductor space, and that the prices are sort of bottoming, inventories are bottoming, and so they're actually painting a very nice picture going into 2024. Now, this one is not on an ADR. It trades on the London Stock Exchange.
Sure.
So under the symbol of SMSN. So you can buy it here around 1360, down around 1300, and then about 1200.
Kim, thank you very much indeed. First idea is Boardwalk REIT, the big Alberta landlord. Of course, they're in other parts of the country too.
Yes, Bloomberg had a great headline this morning. Soaring Canadian housing costs drive population boom in Alberta.
Right.
That really tells the story for Boardwalk. Boardwalk provides affordable housing for Canadians, and with a concentration called 70%, between Alberta and Saskatchewan in their portfolio. What is great about their portfolio is that, notwithstanding the fact that they're able to get 9.4% rent increases on renewals or 15% rent increases on new leases, rents continue to be affordable for them, just like that article suggested. If you were to look at rent-to-income ratios for them, they're in that 24 to 30% range. Typically, you'd find in other parts of Canada, it's in the high 30% range. The stock trades at a wide discount to net asset value, and that net asset value continues to grow every quarter as they're able to generate these high top-line numbers I mentioned. We think same property net operating income could be anywhere from 12.5% to 14% this year, and we wouldn't be surprised if we saw a similar number next year. I think that's a really great story to tell whether or not we're going to recession or soft landing. I think this is a really easy story to understand when you have population growth, limited new supply, and pricing power.
Okay, we've got First Industrial Realty Trust, trades in New York. What are they all about? Are they warehouses?
They are warehouses in the top markets in the United States, really concentrated in 15 of the top markets in the United States. They operate around 65 million square feet of industrial warehouse. Outside of Dream Industrial, this is our best idea in industrial warehouse globally, because it trades at one of the highest discounts to net asset value, over 20%. 25% of its exposure is in Southern California. That's been a really strong industrial hub, though recently new supply has met some of that demand, and you're not seeing the same type of pricing power. We think that pendulum's going to turn beginning next year, because with inflation, we've seen construction costs increase tremendously, and hence new starts have really gone away. So you could paint a scenario beginning in the second half of 2024 where you're going to have heightened new demand for industrial. We talked about factors like onshoring and reshoring creating really great demand drivers at a time where there's no new buildings to meet that new supply, to meet that demand. And so we think First Industrial is really poised to take advantage of this at a time where, even if there isn't any further market rent growth, they can capture 40 to 50% uplifts in their expiring leases because of that mark to market that they've had in terms of leases that were signed many years ago at much lower rental rates. So we think this is a great stock to own, great setup into 2024. And if the discount persists, it could be one of those M&A takeouts that we've benefited from in our past 15 years.
Okay, and then finally, Chartwell Retirement Residences.
So Chartwell's been an interesting story. This is one of the largest operators of retirement homes across Canada. The retirement space has been a laggard in terms of its recovery on the operational side post-COVID. We hadn't seen occupancy really recover. It had bottomed, but we hadn't seen an occupancy recovery until this year. I think we've seen over 400 basis points of occupancy improvement at Chartwell's facilities, and that is really generating right down to the bottom line. Whereas there were questions before, could they sustain their distribution? I think it's obvious now that they can. And as occupancy levels get back to where they were prior to the pandemic, at a time where you now finally have that great demographic boom of seniors, of the baby boomers looking to move into this type of product, you could paint a scenario where cash flow growth could become material, and hence net asset value could be increasing. So it already trades at quite a wide discount to net asset value, and I think if you could see one of the higher cash flow growth stories out of real estate next year in Chartwell.
Sorry, why is it trading at a discount, would you say, Andrew?
It's top line versus bottom line. On the top line, we were slow to see recovery in terms of new residents. At the same time, expenses have been much higher in this business, attracting new labor and staffing, higher wage costs. You've seen margins become compressed. But as soon as you see occupancies go from what were the mid 70s to 80 to 85%, yet expenses stay static, you're going to see margins improve, and that cash flow really go down to the bottom line. So the stock had underperformed because it was a bit of a show me story. Was there something broken in the business model? Were people reticent to move into retirement homes post-COVID? And I think they've shown over 2023 that the thesis is still intact.
Andrew, go big picture with us. If interest rates have peaked, that we're done with the increases, or nearly all of them, what sectors of real estate will do well over the next year, do you think? Could you point to one area of the real estate market?
Absolutely. I mean, lower interest costs are going to be a tailwind for everybody in real estate, but it really comes down to what are the real estate fundamentals? Where's demand exceeding supply? And we talked about apartments in Canada specifically, where there aren't any rent controls in Alberta. We've talked about industrial warehouse globally. We've talked about manufactured housing in the United States, and probably the best setup is for grocery-anchored shopping centers in Canada through a name like First Capital REIT, where it's defensive, but cash flow is going higher, and you have population growth. If you have interest costs coming down, that's going to be a tailwind to all these names and all these sectors.
And give us your take on retail. You talked about RioCan, and I think you said the distribution looks solid for now, but grocery reasonable, but other types of retail real estate, will it still be under pressure, do you think?
I think the pandemic proved the resiliency of necessity-based shopping centers. Yeah. And as well as if you have population growth and you have the dominant grocery shopping center, you're just going to see sales improve and hence rents improve. Enclosed retail malls, that's more challenging in the sense of we've seen a lot of bankruptcies. We've seen a more challenging environment to backfill some of those bankruptcies. You've had to go to more entertainment, restaurant uses, et cetera. And if you're in an environment where the consumer is going to be spending less, they're going to be spending, they're going to keep their capital, direct their capital towards more necessity goods, but perhaps spend less on general merchandise and clothing, et cetera. And that has to come at the sake of them all.
Andrew, always great talking to you, and thanks very much indeed. Let's head to Cambridge, Ontario, on the banks of the Grand River. Tom, go ahead, please.
Yes, I'd like your guest's opinion on Thermo Fisher Scientific. It seems to be down this year. Wondering if it's a good choice at this time. Thank you.
And Tom, can I just ask you, sorry if you don't mind me asking, why are you interested in Thermo? Because it is a fascinating stock, but of course, it's such a specialty company with its scientific equipment.
I'm looking for something in healthcare and something that's been down that hasn't participated yet in the rally, and it seems like a picks and shovel type business.
Thanks, Tom. Yeah, that's really interesting to get your thinking on that. Brianne, Thermo Fisher.
Yeah, TMO is definitely a stock that we like and own in the portfolio. I think, again, giant life science products and services company. Consumers are kind of the firm. It may not be that well known as you mentioned. So some people might not have it on their radar, but I do think it's matured into almost $189 billion market cap company. So it operates 4 business segments: that life science, that analytical and specialty and lab products. And it's kind of snowballing through acquisitions. So it has spent tens of billions of dollars completing dozens of purchases in M&A, which is great. It added life technologies. It added a few other M&As. And besides M&A, the firm operates in a growing life science market. So we expect top and bottom line for this company to grow further because of the end markets and acquisition. Relatively new as a dividend stock. Started distributions in 2013 and increasing them in 2018. But I do think, too, still lower on that dividend stock, but great value and defensive name from a healthcare perspective. So headed into kind of 2024 and positioning the portfolios a little bit more defensively, we think that this stock could actually do very well. And we expect kind of a double-digit increase to continue for this company. And they do have, due to their minimum payout ratio of roughly 5%. So the company's net debt is rising because of the acquisitions, and the leverage ratio has reached 2.6 times. But it has investment grade credit rating. So elevated valuations between 18 times to 26 times, current forward PE of about 21 times, in the middle of the range. So, not a huge discount, but I do think that there is a lot of upside to this stock, and fundamentally it scores a 10 out of 10 for us. So I do see from analysts across the street a buy rating, and it is a stock that we continue to hold in the portfolio and do like over the next 12 to 24 months.
Okay, let's get to those top picks as advertised. Walmart is your first idea here.
Yeah, Walmart. So Walmart has kind of been a leader in revenue and kind of the discount chain store. So on the last earnings report, they have beat earnings and revenues. So not really a surprise. They've been beating them together in consecutive 6 quarters. We have seen a sell-off, as you can see in the stock there. And we think the recent drop in price has been more due to the guidance that was issued by the CEO for next year. They increased their previous earnings guidance, but market was expecting more. So we are starting to see some companies proactively come out and say they are expecting consumers to slow that spending and reducing their guidance. So Walmart expects sales growth to moderate in Q4 as inflation in the grocery price sales has slowed. But again, in times of economic duress or heightened inflation, Walmart's appeal to bargain shoppers is really unmatched. Of the 30 stocks that make up the Dow, Walmart was the only one whose stock went up between 2007 and March of 2009. So in other words, Walmart was the only big blue chip company in America to produce a positive return during the onset of kind of the 2008 financial crisis. So it scores an 8 out of 10 and still a lot of over 15% upside for us.
Your next idea is in the pharmaceutical industry, Abbvie.
Yeah, Abbvie. So pharmaceutical company, one of the top 10 largest by revenue in the biomedical segment. They recently announced plans to buy the cancer drug developer Immunogen for $10 billion. And they are trying to join in kind of that race in the development of the treatment that aims to target only cancer cells, so potentially reducing toxicity for other cells. Pfizer and Merck, we also own Merck, already announced similar acquisitions of companies related to this treatment. So now they're hopping on board as well, which is great. They have been showing resilience since 2019. And so the 5-year total return on Abbvie is for the stock is around over 90%. So as you can see, price target around that 166 US. So for us, looking at that 5-year total return of over 90%, that means if you put $1,000 invested in 2018, that would be worth $1.9 million today. So again, great dividend yield of 4.3%. It is a good dividend king, has increased its dividend over the last 50 consecutive years, and still has a good ranking of us. RJ actually just bumped up their target for the stock from 177 to 181. So over 30% upside potentially from here.
It's interesting. The drug stocks are tricky, aren't they? Because it's so technical evaluating these medications.
Yeah, they are. I mean, and as you're seeing a lot of changing, and I know you were talking about it too earlier on the dietary drugs coming out. So there is a lot that has to, they're waiting, M&A, patents, etc. So some things that definitely can cause additional volatility in the stock. But again, we want to be overweight, and we are currently overweight healthcare headed into 2024.
And then finally, you are a bit of a gold bug, gold bullion ETF. You like the look of this one. Here's one option, VALT. I love that ticker symbol.
Yeah, I don't know if a gold bug is the right word.
Okay, sorry, kind of joking.
But maybe right now, yes. I would say we saw kind of gold regain its attention. A lot of it due to the Fed, right, coming out and some comments today too, but potentially reducing rates sooner than later, and also a weaker U.S. dollar. So as we expect economic data to start to ease, and we also expect kind of a flight to quality, we do expect gold to continue to appreciate on this upward trend. Once the Fed hits peak rates, which we believe we've seen, gold should continue and should have some potential tailwinds to help it on this upward rally. We have held gold for a while, but increased our position by adding VALT, V-A-L-T, and to our portfolio before this last run up. Historically, gold does also begin to perform well in anticipation of lower rates and weaker US dollar, which we are expecting to continue. So we are watching this sector very closely, as we do believe there's other opportunities here. But right now, VALT is kind of returning more than even the TSX. So gold seems attractive for us, and at least until the first quarter of 2024, when we expect the economy to kind of start absorbing the full impacts of rate hikes, and also a way to really diversify and position your portfolio a little bit defensively.
Would you generally, if you're feeling positive on gold, would you prefer to hold a bullion ETF or an ETF that holds gold miners?
For us, if we are very strong conviction, we do like the miners at certain times. I would say, again, a little bit more higher risk, a little bit more volatility. From a safer bet, gold bullion is kind of our expectation. If we do have a strong conviction, though, we will shift into the miners that way as well.
Yeah, it is fast. What about silver? Is that on your radar, or copper, or any of those other metals right now?
Yeah, copper's on our radar. Silver, no. We do also own wheat and precious metals, so get a little bit of exposure to the sector as a whole there as well. But yeah, we do are bullish on copper as well.
We had better jump. Brianne, thank you very much indeed for joining us.
Thank you.